Hi there, I'm Edward Kalstian, founder of EKH Capital, where we look for market-beating stocks for the long run. Today, we're diving into Northrop Grumman, a quiet powerhouse in US defense. From the B-21 stealth bomber to advanced missile systems, space assets, and AI-driven cybersecurity, this company is deeply entrenched in America's defense backbone. With global tensions escalating and NATO allies increasing its military budgets due to the new NATO 5% rule, the question is Northrop Grumman still undervalued, or is the growth story priced in? Let's run it through our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. Let's start by asking, is Northrop turning its investments into real value? Northrop Grumman's return on invested capital sits at 9.5%, below our 15% threshold, but still solid for a defense contractor operating in a heavily regulated, capital-intensive sector. The return on equity is 25.4%, which looks fantastic, but let's not get fooled. A large chunk of that comes from share buybacks. In fact, total equity has been flat at $15 billion over the past 3 years, meaning buybacks are doing heavy lifting. So capital efficiency isn't the lead, but the company's capital allocation is clearly shareholder-friendly and deliberate, which is a big plus. Northrop's growth profile is stronger than it might seem at first glance. Over the last decade, revenue grew at a compounded annual growth rate of 6.4%. Net income grew at a CAGR of 8.6%, and earnings per share grew at a CAGR of 11.8%. That 11.8% earnings per share growth is key. It's outpacing both top line and net income, thanks to disciplined execution and buybacks. This is the kind of compounding that long-term investors should love, especially in a sector where predictability and scale matter more than flash. With major long-term contracts like the B-21 Raider and ground-based strategic deterrent, plus growing demand in space and cyber, that growth looks durable. Strong growth is only sustainable with a solid balance sheet. But here's where things get nuanced. Cash and short-term investments sit at $4.4 billion, with total debt at $18.4 billion. Debt to equity is at 1.2. That leverage is a bit high, but keep in mind, equity is suppressed due to buybacks. So let's pivot to free cash flow to debt instead. Free cash flows as of fiscal year ending 2024 sit at $2.6 billion. That covers about 14% of total debt, where 10% is the bare minimum. This means that Northrop could retire all debt in under 7 years if needed. Not ultra-conservative, but acceptable, especially with a defense-grade cash flow profile. Even great companies can make poor investments if you overpay. So how is Northrop stock valued today? Northrop trades at a price-to-earnings ratio of 20.4. Almost identical to Lockheed Martin at 20.3, far below Raytheon at 43.6, and miles better than Boeing's negative multiple. With earnings per share growing at 11.8% CAGR, the implied PEG ratio is roughly 1.7. At 1.7, Northrop appears moderately overvalued, meaning investors are paying a premium for predictability and defense exposure. But in the context of steady cash flows, government contracts, and long-term earnings visibility, it's not unreasonable, just not a deep value play. So Northrop is not screaming cheap, but for the quality and growth, the price seems fair. Can Northrop's moat protect its profits for years to come? Northrop's competitive advantage is rock solid. Proprietary systems like the B-21, hypersonics, missile defense, and space platforms, plus decades-long trust with the US Department of Defense and allied governments. Add to that high barriers to entry in defense aerospace, and finally sticky contracts and switching costs that are effectively immovable. And their moves in autonomous systems, cybersecurity, and AI-enhanced defense platforms give them a forward-looking edge in next-generation warfare. So Northrop's moat is deep and getting wider. Before we wrap up, The clean, detailed charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Is Northrop Grumman an undervalued titan or growth mirage? Return on invested capital of 9.5% and return on equity of 25.4%. which are solid returns enhanced by stock buybacks. An 11.8% earnings per share CAGR results in high quality compounding. That is on the high side, but manageable given free cash flow strength. Northrop's price to earnings ratio of 20.4 and PEG ratio of roughly 1.7 indicate it's slightly overvalued, but reasonable for a high quality defense name. Northrop's moat is deep, sticky and forward-looking in defense and space systems. Northrop Grumman may be one of the most compelling defense stocks of 2025. It's not undervalued, but it's priced reasonably for what an investor gets. Predictable growth, healthy capital returns and long-term relevance in a high barrier industry. What's your take? Underrated titan or priced just right? Drop a comment, hit like and subscribe and let me know which stock you want to see next. Thanks for watching and I'll see you in the next one.